You put your money in the market to watch it grow, but what if your own brain was its biggest enemy? There's a famous study from the investment research firm Dalbar. It found that over a 20-year period, the average investor's returns were significantly lower than the overall market's returns. We're talking about missing out on huge amounts of potential wealth. Why? The market didn't fail them. They didn't pick bad companies. They fell into common psychological traps. They made emotional decisions that quietly stole their money over time. Welcome back to Invest Easy 101. I'm your host. Today, we're going to expose the 7 most common and costly traps that catch new investors. My goal is simple. By the end of this video, you'll be able to spot these traps before you fall in. You'll understand the real-world cost of each one, and you'll have a simple set of rules to stay on the path to long-term growth. Let's dive in. Trap 1. Chasing the hot trend. The first trap is like seeing everyone run to one side of a boat and deciding you need to join them. This is chasing the hot trend. A stock, a crypto, a sector is shooting up, headlines scream about it, friends talk about it. The fear of missing out, FOMO, kicks in, so you buy in, often at a very high price. Here's why it matters. By the time something is a mainstream hot trend, the big, easy gains have usually already been made. You're late. You're buying from someone who got in earlier and is now happily selling to you at a premium. Then the trend cools off, the price falls back to reality, and you're left holding the bag, often selling at a loss. You didn't invest, you speculated on a hype cycle. The cost is buying high and selling low, the exact opposite of what we want to do. Trap 2, panic selling. If trap 1 is buying out of greed, trap 2 is selling out of fear. This is panic selling. The market has a bad week. A stock you own drops 10%. Red is all over your screen. Your stomach churns. To make the feeling stop, you hit sell. Think of it like this. Imagine you own a piece of a fantastic local bakery. One day, a big chain opens across the street and your bakery's daily sales dip for a month. Would you immediately run in and sell your share of the bakery for half price to the first buyer? Of course not. You'd wait to see if it recovers. The stock market is the same. Prices fluctuate daily. Panic selling turns a temporary paper loss into a permanent real loss. That Dalbar study I mentioned, panic selling during downturns is a huge reason for that gap in returns. You lock in the loss and miss the eventual recovery. Trap 3, overtrading. This is the trap beginners always fall for. It feels like action. It feels like you're in control. It's overtrading. This is constantly buying and selling, trying to time the market's every move. You think you can get out before the dips and jump in before the rises. Here's the brutal reality. Even most professional fund managers cannot consistently time the market. For a beginner, it's essentially guessing, and each guess comes with a cost, trading fees and taxes. It's like trying to find a new, faster route home every single day. Most days, you just hit more traffic lights and burn more gas. Sometimes you get lucky, but over a year, you've wasted time, gas, and caused yourself a lot of stress compared to just sticking with the reliable route. Overtrading burns your capital with fees and often leads to worse returns than just holding good investments. Trap 4, confirmation bias. This is a sneaky one. Confirmation bias is when you only seek out information that agrees with what you already believe. You buy a stock because you love the company. Then you only watch videos, read articles, and follow people who are also bullish on it. You ignore or dismiss any critical news or warning signs. Why it matters is because you stop being an objective investor. You become a fan. Think of it like only asking your biggest supporter if you're ready for a big job interview. You need the critical feedback to prepare properly. In investing, ignoring contrary evidence can keep you holding on to a bad investment long after you should have reevaluated. You need to actively seek out the bear case, the reasons not to own something to make a truly informed decision. Trap 5, the get-rich-quick mindset. The market is not a lottery ticket. Treating it like one is a sure trap. This mindset leads you to put a huge portion of your money into extremely risky speculative bets. It's the idea that you'll find the one stock that will go up 1,000% and solve all your problems. Let's be clear, Building wealth in the market is a marathon, not a sprint. It's about consistent growth over decades. The get-rich-quick mindset focuses on the thrilling, unlikely home run while striking out on the steady singles and doubles that actually win the game over time. The cost is massive volatility and the high probability of significant losses. It can wipe out your capital and, worse, make you give up on investing altogether. Trap 6. Not understanding what you own. This trap is buying something just because a friend mentioned it or you saw a ticker symbol online. You invest in a thematic ETF without knowing what stocks are inside it. You buy a stock because it's a tech stock, but you have no idea how the company makes money. If you don't understand it, you can't evaluate it. When the price moves, you have no framework to decide if it's normal or a reason to worry. You become vulnerable to every headline and piece of gossip. It's like buying a car without ever looking under the hood or taking a test drive. When it makes a strange noise, you have no idea if it's serious or not, so every little sound causes panic. Understanding your investments gives you the confidence to hold them through normal market noise. The final trap is ignoring costs. The final trap is forgetting that fees are a silent thief. Every mutual fund, ETF, and robo-advisor has an expense ratio. Every trade might have a commission. These small percentages seem tiny, but they compound against you over decades. A 2% annual fee doesn't sound like much, but on a portfolio that averages a 7% return, that fee is eating over a quarter of your potential profit every single year. Over 30 years, that can mean hundreds of thousands of dollars lost. It's like a small leak in a water pipe in your basement. You don't notice it day to day, but over a year, your water bill is enormous and you have a mold problem. You must always look for the leak, the fees, and plug it by choosing low-cost investment options. Knowing the traps is one thing, avoiding them is another. So here's your simple, repeatable framework, a 3-step checklist to run through before you make any investment decision. Step 1. The pre-check question. Before you buy or sell anything, ask yourself, am I making this decision based on a proven long-term strategy, or am I reacting to an emotion like greed or fear right now? If it's emotion, pause. Do not click the button. Walk away for 24 hours. Step 2. The strategy safeguards. These are the rules you write down before you're in an emotional situation. For buying, I will only invest in things I understand. I will not invest more than 5% of my portfolio in any single speculative idea. For selling, I will only sell an investment if the reason I bought it is no longer true, or if I need to rebalance my plan. I will not sell simply because the price is down. For costs, I will always check the expense ratio and will prioritize investments below 0.25%. Step 3. The regular review ritual. Once a quarter, not once a day, review your portfolio. During this calm review, ask, do I still understand what I own? Have the fees changed? Am I still diversified? Am I sticking to my long-term plan? This ritual replaces the urge to check prices daily. It moves you from reactive to proactive. Now, for total honesty, following this framework won't make you a millionaire overnight. That's not the goal. It is designed for long-term, steady wealth building. It is not designed for short-term speculation or trying to beat the market every year. You will still see your portfolio value go down sometimes. That is normal. This framework is about preventing you from making those downturns permanent through poor decisions. It requires patience and discipline, which are muscles you have to build. The biggest risk is not the market crashing, it's you abandoning this sensible plan out of boredom or impatience before it has time to work. So, to summarize in one sentence, your greatest investing edge is not a secret stock tip, but the discipline to avoid common emotional traps. Your clear next step is to take that 3-step Invest Easy avoidance framework and write it down. Put it on a note next to your computer. That's your shield. If you found this helpful and want more clear, hype-free guides to building your wealth with confidence, please subscribe to Invest Easy 101. Hit the bell so you don't miss our next lesson. Now, I'd love to hear from you. Which of these traps do you think will be the hardest for you to avoid? Let me know in the comments below. Thanks for watching. Until next time, invest smart and invest easy.